Welcome to Wealthion. I'm Wealthion founder Adam Taggart. I conducted an interview on Twitter Spaces the other day about the unfolding catastrophe happening with Airbnb properties across the US. I found the discussion both important and fascinating, and I really enjoyed the analyst I had it with, a new voice to the financial media space that I think you'll value getting introduced to. So I'm releasing the interview in its entirety here for you. A heads up. It's audio only, so you don't need to be glued to your screen while it plays. Maybe get a walk in or get some chores done while you listen. Enjoy.
All right. Hopefully folks can hear me here. Welcome, folks. I'm Adam Taggart. I'm at Menlo Bear on Twitter. I'm also founder of the macro YouTube channel Wealthion. Today here, I'm joined by Amy, who goes by the handle at Texas Runner DFW on Twitter. She has got a background in economics and journalism, and she covers the real estate market as closely as she's able to for her followers while she raises a family. Amy, thanks so much for joining me today. I understand that this is your first Twitter space?
This is. Hopefully I'm doing this correct.
All right, well, it sounds good so far.
Okay.
Well, look, thanks for taking time out of your Sunday to do this for me, Amy. And for folks listening, I just pinged Amy a couple hours ago. We'd never talked before, and kind of caught her in the middle of a regular Sunday there, and she was gracious enough to carve out a little bit of time to do this space with us. So, Amy, let's just jump right in here. I got a couple of prepared questions. We'll talk for a bit, and then maybe we'll take a couple of cute questions from the audience here. You and I have been tweeting a lot of late about the deteriorating health of the U.S. real estate market. Recently, though, you've been ringing a particularly loud bell about the vulnerability of the Airbnb part of the market, predicting what you're calling an AirBnBust. What about it has you so worried?
Yeah, I'm not sure if I coined that term or not, but I did call it an AirBnBust. I'm speaking about all short-term rental markets, not just necessarily Airbnb. I just think Airbnb is the biggest brand, so I kind of honed in on that
Okay,
one.
but like Verbo and some of the other rentals?
Yeah,
Okay.
it's all under the same short-term vacation rental umbrella. So I think what started triggering the alarm bells for me was about a year ago. I just noticed an increase in just people, anecdotally, people I know, people on Facebook, people I know in real life, picking up an extra vacation property here or there. And it started to sort of snowball into a scenario where I was starting to see people that have zero background in property management, very little background in real estate. And they're out there suddenly now owning maybe 10 or 12 of these properties. And some of their reviews were coming in 1 star. There was a lot of PR problems for them. There were people in Facebook groups saying, do not stay at this person's property. And meanwhile, Airbnb has them as a super host and their properties are being promoted. But then people that I knew in real life were like, this experience was a nightmare. And so I was kind of starting to see these two things don't quite line up with reality here. And so I sort of dug into it and started looking more. And I forget who posted the other day, but somebody said, I think over 50% of short-term vacation rentals have been purchased in the last 2 years in the US, which is kind of an alarming number.
Wow. Yeah. So it's sort of like there's a bit of an everybody's doing it now phenomenon going on here.
Yes. And to the point where I think now there's not just a market for short-term rental income. Now there's a market for coaches and, influencers that want to sell how you can own your own little Airbnb empire. And then it started to remind me of an MLM, which incidentally, the people that are local here that first triggered me off to this, I looked into their background and they actually were at the top of an MLM company for a while before they rolled into this.
All right, and sorry,
and I saw a lot of those.
Sorry to interrupt, but just for people that maybe don't know what MLM means, you're talking about multi-level marketing scheme, correct?
Yes, sorry. Like Mary Kay is like Amway. Those some people call them pyramid scheme. but it's where you start to make your money by selling the idea of the business rather than the business itself. And there started to be a whole bunch of these groups. I think there's a bigger pockets podcast is one of them.
Bigger pockets.
There's like now this whole other empire around selling the concept that you can get rich buying short-term rental properties, even if you have no experience. And that to me just got kind of scary, because I think, you've got people, some of these loans they're not Freddie Fannie loans the way you would buy a home for you to be owner occupied. So people are taking personal loans, people are syndicating, they're pooling money and grouping it together to purchase these properties. I think that there's a lot of leverage in the system, and it's all based on cash flow. So my concern then was, hey, it looks like we're going to have this post-COVID travel boom. People have been locked down for over a year. They're antsy. They want to take that vacation. Starting this spring, we started to see a flurry of vacationers, a lot of people wanting to go on these trips. I think a lot of these properties were getting booked.
Yeah, and by the way, too, they had stimulus payments burning a hole in their pockets too.
Yes, stock market was at an all-time high. Stimulus payments were hitting, and people wanted to take that vacation. So I think probably a lot of these properties got booked at first, and it seemed really lucrative, and they were telling other people about how lucrative it was. And sort of an unfortunate snowballing effect was you reached a point about midsummer this summer where there's suddenly too many properties in some regions. It's just oversaturated. And you're starting to see a slowdown in demand because the prices have gone up. The cleaning fees, the extra taxes and fees have gone up. And people are also starting to realize, hey, my 401k is down 20%. Hey, I spent that stimulus money months ago. Maybe we're done with our vacationing. And I think as the summer wore on, that just continued to deteriorate. And I started to see it in just friends that I know. I started to see people advertising on Facebook, hey, my Airbnb is vacant all September. Is anybody interested? We're going to offer this discount or that discount. And that's what made me actually go to the Airbnb Superhost group online and find those posts that I put in my tweet, which blew up the internet, which I never expected it to do that. But yeah, that's kind of how we got there.
All right, let's pause here for a minute, because I want to read first this tweet that you're talking about that Zero Hedge ended up retweeting, as did other publishers, myself included. And it seems like you saw a huge flurry of activity from that. But you were retweeting basically a tweet here from the Airbnb Superhost group. It starts with this one question that one of them is asking, which is, what's going on with Airbnb? No bookings at all. And then there's another one under it here that says, has anyone seen a huge decrease in bookings over the last 3 to 4 months? We went from at least 50% occupancy to literally 0% the last 2 months. I'm just curious if this is something only going on in my property or if other people are seeing similar things. I'm in Palm Springs. So we're beginning to see at least anecdotal evidence like this, that bookings are drying up. And you mentioned that's potentially likely due to falling consumer demand. And on the macro side of things, I talk an awful lot about how every week we're seeing more and more data that the economy is continuing to slow, that we are heading into recession. There's a lot of debate right now whether we're in one or not. There was the famous public discourse over, hey, what's the definition of a recession anyways? Bloomberg Economics just came out earlier this week with their latest model forecasting a 100% chance of recession in the next 12 months. So whether you think we're in one or not, clearly the trajectory is downwards. Big thing that Jerome Powell, head of the Fed, is trying to do is depress demand by all the interest rate hikes that he's making and the quantitative easing that he's begun. So, we're in an environment where the economy is cooling off, and therefore demand for luxury travel or discretionary travel should be coming down anyways, right? So you've got that. The stimulus obviously is over. As you said, people were feeling cabin fever from being locked down over COVID. That's in the past now too. So they've gotten they've gone out, they've stretched their legs. Now they're getting back to real life. There's another thing you mentioned I just want to spend a moment on too, which is there's become a real affordability issue with Airbnb now. When it first came out, it was kind of like the couch surfing solution, right? It was the way to kind of get a cheap listing in an area rather than having to buy a night at a hotel, with all the expenses that come along with it. Well, now what's happening is the script is basically flipped, which is the hotels are seeing falling demand, and they're bringing their prices down as a result. And Airbnb, the prices had been pushed up by lots of consumers traveling. And you mentioned cleaning fees. Because of inflation, the cleaning crews are charging an awful lot more. It just costs more to run these Airbnbs. The mortgage debt to buy them now costs more. And so now the price of the Airbnb is no longer competitive versus hotels. And in a lot of cases, it's more expensive. And on top of that, a lot of these Airbnb hosts are asking you, yes, I'm going to ask you to pay this exorbitant cleaning fee, but I'm also going to ask you if you can put everything in the dishwasher before you go, if you can wash the sheets. Some of you had said, I need you to mow the lawn. So people are just like, why would I stay in an Airbnb when I can go to a hotel when it's cheaper and I don't have any of these other hassles? So there's all of a sudden kind of like this affordability crisis going on there. So I'll take a pause here, but is there anything else you want to add to that?
Yeah, and I think with the affordability aspect of it, I do think that was one of the major advantages of Airbnb in the early years. And with that gone, I think they kind of need to have another competitive advantage. And I was just talking to a different reporter last week who asked me kind of like, is this just Airbnb model no good, or can people still succeed with it? And my answer is people can still succeed with Airbnb, but you need to have a competitive advantage to your property. It needs to be unique in some way. It needs to be exceptionally well run. And you can no longer just buy, Joe's house in suburbia and go buy some decor at Marshall's and expect that you're just going to be able to command top dollar. You've got to have a really unique location or something really funky and interesting about your property that's going to draw people to say, hey, if this is the same price as a hotel or more, it's going to be worth it because I'm getting some value that's extra.
Yeah, it's a great point. And I actually want to kind of at the end of this discussion, kind of ask you to opine a little bit further about the Airbnb model. Let's put a pin in that just for a second.
Okay.
Because I want to get into the cash flow part of it, the negative cash flow. Before I do, I just want to make one last point, which is, you were sort of saying that we saw this huge influx of people becoming Airbnb hosts. I think you said something like 50% of the listings have been purchased in the past 2 years, something like that, if I got that stat right.
Yeah, it was a little over in the US. It might have even been over 60. It was at least over 50. It's pretty high.
You said super high. There's another dynamic going on in parallel, which is the baby boomers, as they have been, so for years, people expected that there was going to be kind of a depressing factor on home prices as the baby boomers got to the age where their kids are out of the house, they're now retiring, and they're going to downsize, right? They're going to downsize to a more modest sized residence. And what they've found is a lot of them, yes, they moved and downsized to a smaller residence, but they actually didn't sell their older residence. They, it had been appreciating so much every year that they just sort of held on to it, like assuming it sort of like a stock. I'm just going to keep it in part of my investment portfolio because it goes up by X% every year. And so they would rent that out, right? Either long-term rents, or they'd make it an Airbnb property or Vrbo or whatever. And so I just want folks to realize that it's not just the branded Airbnbs and Vrbos that are out there. It's also just sort of a material part of the U.S. housing stock has become rental property that become incremental rental property that sort of folks weren't prepared for. And the reason why all this is important is now we get to the cash flow part, right? So you said, Amy, that a lot of these people are relatively recent buyers. Some percentage of them took out probably, uh, you know, uh, irresponsible or near irresponsible type loans if they were getting pulled in as part of these MLM coaching services and whatnot. And so that all works fine as long as the fees are going up and vacancy rates are good. But once people can't afford the fees and the vacancy rates start plummeting like we're seeing now, then all of a sudden this thing becomes an albatross around their neck, right? And a lot of the people who really had to borrow to get in the space, they don't have a lot of cushion to absorb too many months of negative cash flow before they just have to get out, right? And so I'm going to talk with you a little bit about sort of the state of the general real estate market, but what's important to know about these Airbnb hosts, especially the Johnny come latelys, and especially the ones that are levered, is that these are really weak hands in the real estate market, right? If housing prices start softening, if it's your house, you're going to be reluctant to sell and you're going to do everything possible to stay in your house for as long as you can afford to. But if this is an investment property, especially one that you got into with too much leverage, especially pretty recently, to try out, hey, is this something I might want to, a way I might be able to make some extra money, you're going to be like on a first in, first out basis. Like, whoa, this thing isn't what I thought it was. I'm getting out of here. Just sell the house. Right. So it's going to be a depressing factor as the housing market starts weakening. A lot of people say, well, there's a lot of people sitting on 3% mortgages. They're just not going to sell. So there's not going to be an inventory. So the housing market isn't going to go down. I would posit to say, no, a lot of these investors, especially the small retail ones like we're talking about, they're going to be like the first ones out. And they're going to be dragging all home prices down with them because real estate is priced at the margin. So what do you think about that?
Yeah, I think that's absolutely true. I think some of the way that some of these loans are structured too, I mean, if they took a personal loan or they leveraged against their own home that they live in, these are not 3% rate loans. Some of these loans could be, 7, 8%. If they're personal loans that are off the books, they cannot be sold through Freddie Fannie. Some of these loans are going to be floating rate loans. So these interest rate rises are really going to put these people in a
God, you're just
pinch
squeezing them,
if
yeah.
if they aren't cash flowing and now suddenly they are owing more on their debt. That's going to be a real problem. And yeah, I think that probably from what I'm seeing, there's going to be two instincts. Instinct number one is going to be like, this was a terrible idea. I need to sell this property right away. Instinct number two is for the person who's like, maybe I can still make this work. I'm going to turn it into a long-term rental. So I'm also hearing from people saying, yeah, I pulled my vacation rental and I'm trying to now rent it out to a family, like a long-term single family rental, which in my opinion is great for the housing market. My goal is affordable housing for people that want to live in a house. So if they want to take a short-term rental and turn it into a long-term rental, that's totally fine. But what you're going to see then is that's going to start to put downward pressure on
home prices.
rental prices.
Well, rental prices and home prices, because theoretically,
and home prices.
Yeah, theoretically. So in other words, it's kind of great for renters, right? Excess inventory, all competing for renters. It's going to bring the price of rents down. So long-suffering renters are hopefully going to get a break here. But if you're a homeowner, homes they're basically supposed to be priced on the rents that you could get for that home, right? Or priced on what incomes in that area can afford. It's theoretically supposed to be a discounted cash flow valuation. So rents come down, theoretically home prices should come down too.
Yeah, which is interesting because in Dallas Fort Worth, I would say right now there is a large gap between like what it would cost to service a mortgage on a home, assuming a 8% or 7% or 8% rate with 20% down, versus renting a similar property. There's already a pretty sizable gap between those two. It is significantly cheaper to rent. So I can't imagine anybody buying right now would be able to cash flow a property.
Yeah, that's really interesting. That's really interesting.
I don't know if every region is like that, but I know that our region, because we have really high property taxes. I know our region is like that.
Okay, so but it sounds like what you're saying is, that's you're hearing sort of plan A or plan B. Plan A is I'm just getting out, selling it, don't care what the price is. I just got to protect whatever I can keep. And then the second is I'm going to try to make this work as a long-term rental. I guess sort of TBD how successful that cohort will be at being able to do it at a way that cash flows enough for them to want to continue doing it.
Yeah, because there's going to be a spiral, a downward spiral, I think, in particular regions where they're very short-term rental heavy. I think you're starting to see it happen in the Phoenix market. There's certain markets in California as well. There's so many short-term rentals that you're going to start to see people trying to bail on them, but you're also going to run into a problem where no one's going to want to buy them because they don't want to live in a hotel neighborhood.
Right.
And they don't want to be the person that's living around 15 Airbnbs on their
Right.
street.
A bunch of transients, a bunch of, we hear all those horror stories about people who live next door to an Airbnb that's having all these, unsanctioned parties and stuff like that.
Yes. And worse, crime. I mean, there's really bad stories out there for some of these places, but yeah, I think in general, it probably brings down the value of properties in a neighborhood. And certainly I think several HOAs ban them. But there are certain regions where there are zero restrictions, and some of those places have really gone downhill. I've gotten a lot of DMs from people who have said it's turned our market into a complete mess.
Yeah. So it's funny when you use the term Airbnb bust, there's probably let's talk real quickly about this tweet that you retweeted earlier today from a guy named Mark Jenny. It says, comment from a realtor we talked to in Arizona this week. Quote, I've never seen this many vacation rentals come on the market for sale. Every day, someone is asking us to list their Airbnb for sale. So it sounds like those folks that are in the category of, I'm just pulling the ripcord, I want to get out of here. Sounds like that's already underway.
Yeah. And I think Phoenix, I want to say it was like 8 months ago. I kind of did a demographic search on a bunch of different local housing markets, and I targeted Phoenix and Boise as two that I thought were very vulnerable to severe housing corrections, and I based it on investor activity. At the time, I hadn't broken down how much of the investor activity was for long-term rental versus short-term rental versus the flip. But you're already seeing, especially in the Phoenix market, I mean, home prices are collapsing there. Rental inventory is skyrocketing there. And this has only been, I mean, we're still in the early innings of these interest rate rises. So if this is just the start, I mean, those markets, I mean, Phoenix has always been a boom bust market, but I mean, it boomed pretty hard. And I'm concerned that the bust end could be pretty ugly on this one.
Yeah, well, I mean, I think that's a big reason why you and I have been sort of ringing the bell in general about the condition of the real estate markets. But you touch on something really important here that is sort of different this time with the real estate market, which is there's such a much larger investor ownership concentration in the single family home market this time around, way more than ever before. I don't know what it is for those specific markets, but I've heard in general that the percentage is something like a quarter to 30% of all single family homes that are sold right now are going to an investor. They're not all small, mom and pops that might be buying one or two. There's an increasing amount of, hedge funds or big companies in there. Zillow's a relatively recent famous example that are buying hundreds, thousands of homes in a particular geography. And one, they've been helping drive prices up because they're all cash buyers. They've got really deep pockets. One of the things that I think is really important to keep in mind, it's a point I made earlier, is these guys don't live in the house. To them, this is just an investment transaction. And if the market gets to a point where they're realizing, you know what, these numbers aren't penciling out for us anymore, we've decided we don't want to be in these markets anymore, they can basically flood a market with inventory if they just decide all at once that they're going to cut their losses and run and dump a bunch of inventory. And, yes, they're going to try not to do that if they can. But we've already seen an example with Zillow, where Zillow realized that they overpaid for a bunch of properties and they unloaded them all at once. Now, fortunately, they were able to sell them to another big institutional buyer, so they didn't all hit the market at the same time. You just had one buyer kind of take over the portfolio. But if this is happening in the middle of a recession when companies are fighting for their lives, it very well may not be that orderly. And I personally, am quite concerned that that could be another risk factor here if we get a bad housing market correction that could make it even worse.
Yes, and that is something that I flagged as an area of concern in Dallas in 2021 as well. The actual number for Dallas County was 43% of homes purchased in 2021 were by
God,
investors,
it's bananas. How
and
much? 41%,
over
huh?
43%. And I think it's 46 in Tarrant County, which is our neighboring Dallas County, is Tarrant County. And that's just two regions of Dallas Fort Worth. I think the number today is around 20% for 2022. So your number was correct for current investor purchases. But in 2021, it was over 40%. And I think part of that is why you're seeing now, people have vaguely mentioned this sometimes on social media, like, why are so many homes for sale, ones that people bought in the last 2 years? Well, that's why, because an investor bought it and they either flipped it or they rented it out and they took the appreciation money and now they're done. So they have no attachment to the property. They don't care to own it long term if it's not going to make them money. And it's purely a business deal for them.
Yeah. And so one thing I want to underscore here is I've been hearing this a lot on Twitter is people say, hey, look, a lot of people with 3% mortgages, they're not going to really worry about what happens in the real estate market here because they don't have to sell, right? So they're just going to sit on their properties and inventory is going to be tight and the market's not really going to correct that much. And I think those people are really forgetting that real estate is priced at the margin, which means you got a neighborhood of 10 homes. If only one of those homes sells, whatever that home sells for sets the new comp for that neighborhood, right? So, there are always going to be homes that need to sell for whatever reason. Somebody gets divorced, they die, they lose their job, they can't afford their mortgage anymore, they have to move for work, whatever. So you're always going to have some inventory that's selling. But you add into the mix what we're talking about here, which are these investors who, again, they don't live in the house. They don't have a reason like the other people in the neighborhood do to say, hey, let's not bring our prices down because we all want to keep our home values nice and flush. You get one of these guys who just decides he's out. He can reset the price for everybody.
Yeah, and I think that's a very valid point. I also try to keep hammering home. It's priced at the margins, and I've seen that in our region. There's a lot of homes sitting on the market making these tiny price cuts, but the one that sold is the one that cut 10%. So that one is the new comp. And unfortunately, I think part of what happened this summer that slowed the process down a little bit was people were just pulling their houses off the market and listing them for rent. So you weren't getting a comp
Right. The
at
home
all.
sellers try to go on strike, right? They say, okay, nobody
Yes.
sell, nobody lower their homes. Yeah, okay, maybe we'll take it off, the listing off, maybe we'll rent it for a bit. And then I'm giving the torch back to you here. But eventually somebody breaks from the herd, right?
But eventually somebody has to sell. And it's usually a distress situation, divorce, death, like you said, or just financial distress for any other reason they lost their job. And that, I think, is where we're going to start to see those homes as they slowly, and it is moving really slowly because housing is so slow, but as those homes slowly begin to sell, the new comps are going to be reset lower and the market's kind of going to sort of snowball down. But it still kind of feels like this is the early stages of this
Oh
correction.
God, yeah, I
And
agree.
we've got many major, very respected housing analysts calling for 10% declines next year, maybe 20% if we get a recession, which supposedly we now have 100% chance of having, according to a couple people. So yeah, it's just kind of scary because honestly, I don't think we've ever in the history of our country had respected housing analysts forecasting a 20% drop.
Right.
Nobody did in 2008 because nobody had ever seen the housing market
Right.
drop.
Nobody thought it could happen. And we had all the assurances from Bernanke and the big housing market analysts back then. So yeah, it's never been sort of telegraphed like this. And of course, one of the reasons why it hasn't is general people, our fearless leaders don't like to, because they feel like if they tell people they think there's a chance of recession, people will rein in their spending and then increase the odds of the recession actually happening. but now I think
Right.
I just think it's so inevitable now that people can't ignore it. Right. One other thing that's really important to note here too, going back to the boomers, is a lot of the boomers that are sitting on those 3% mortgages, they have a lot of home equity locked up in there, right? And their plan has been, hey, eventually at some point, I'll sell that home or I'll tap that equity, and that's going to fund my retirement. And if your strategy is, okay, well, I'm going to kind of wait this out and see if we can all not sell and just ride it through this thing. If you start seeing the comps in your neighborhood go down by 20%, 30%, lower than that potentially, you're doing the math in your head and saying, oh my God, I'm losing all of my home equity. So those people, again, are going to be relatively quick to move because they have a first mover advantage. Yeah, much better to lose, cut my price by 10% and get out with, still a good chunk of my home equity than ride this thing down and maybe not have any, by the time I really need it.
Yeah, and honestly, I'm already seeing that. It was some of my parents are the boomer generation. I consider myself an elder millennial, so
A geriatric millennial, I think, is what they call those.
a geriatric millennial. Yes, I'm probably one of the oldest of the millennial group. So my parents, their friends are all in that boomer demographic, and I'm actually starting to see what I'm seeing happen now is a lot of them are starting to sell their primary home, which is large and more expensive, and they're either downsizing, and in the majority of cases these homes are paid off completely or they owe very little on it. In the majority of cases they're either downsizing to a small property in a cheap tax property tax state, or some of them are selling their primary home and simply moving into a beach house they already own somewhere else, or a condo they own it on the ocean. And so that's putting a piece of inventory on the market and it's not taking one off.
Correct. Yeah, no, you're right. And of course, that is the smart thing to do at the individual level, right?
Yes.
It's downside. Let's reduce our cost footprint. The vast majority of our equity is in that big primary home that we probably don't have a mortgage left on or whatever. Like, let's lock that in now, right? So I think, as the herd begins to realize that the race is on, right, to lock in whatever equity you've gained over the years, again, this becomes a wave of selling, right? It becomes a wave of inventory that starts flooding the market. Well, if you're going to sell, shoot, I'm going to sell too, because I don't want to be the guy who's left holding the bag, a year from now, who didn't sell when the time was right. Right. All right. Well, look, 2 questions for you about this, then we'll get to just general real estate comments. And hey, for folks listening, I think there's a way in Twitter Spaces to like give a little high five or wave or something like that. But if there is, and you know how to do it if you're enjoying this. These things are always a little bit hard to know if folks are having a good time or not, because there's no chat feature here. But if you guys are able to do that, that'd be great. Oh, I see a couple of high fives. Great. Thanks, guys.
I saw somebody do one earlier. I don't remember what it was.
Okay.
Some kind of emoji.
All right. Now there's a thumbs up. There's a heart. Okay. That's all good. All right. So I think you already intimated this, but like, how worried are you about how bad this could get? And specifically too, like, what will you be monitoring to track how things are going here? I know that you have access because you have a family member who's works in the real estate industry. What will you be watching most closely to sort of track while this unfolds?
I think probably the biggest thing the most important thing to keep an eye on is how fast inventory is growing. But I think also a main driver of this is going to be a recession, and if we have one, which we're supposed to, and how bad it is. I think then you're going to start to see that rush to the exits where people are looking to lock down whatever cash they can get, and just kind of hunker down. So if we see worsening economic indicators that are indicating the recession is here, I mean, I know they changed the definition, but even with the changed definition, if it starts to look like, wow, we're really running into recession, unemployment is climbing, and especially if we still have this entrenched inflation on top of climbing unemployment, that's going to be kind of a scenario
Worst of
for
everything, yeah.
a worst of everything. Yeah, so I'd probably be keeping an eye on inventory, because you see it already in certain markets like Phoenix. Both rental and for sale inventory is rapidly rising in certain regions, and those are the regions where we're also seeing the fastest price corrections. So yeah, I mean, on one hand, I'm a little bit scared just because there are so many people forecasting a downturn, and that's never happened. And I generally think that, like you said, the mainstream sort of media people tend to downplay things because they don't want to scare the public. So if they're already saying, hey, we think there's going to be, a 10, 15% correction, like, yikes, what does that really mean? But on the other hand, there are people with cash out there. There's people that DM me every single day and say, hey, I didn't want to participate in the bidding wars. I've sat out this market for 2 years. I really want to own a home. I just need prices to come down to something reasonable. And that number is different for every single person. So I think a best case scenario, in my opinion, is prices start to come down and you start to slowly have buyers trickle back in as it reaches whatever their own affordability threshold is. And that will sort of start setting a floor and cushioning some of these markets from just collapsing.
All right. Yeah, I mean, the question is so multifactorial, but you talked about kind of the role recession could play there. The big boogeyman in all of this is layoffs, right? Because
Right.
right now we're talking about people being worried about, not making their investment property cash flow, or, eroding their home equity. But if you add in the specter of people fearing for their income, or losing their income, that's a whole other sense of kind of panic that goes into this market of, hey, I got to get what I can get while there's still something to get here.
Yeah, and I think that will also keep buyers sidelined. If people are wanting to buy a home and they're starting to see layoffs at their company, they might say, hey, wow, I have great income. I've had this down payment saved up for 3 years, just waiting on the sidelines. But I'm afraid to buy now because what if I lose my job or my spouse loses my job? I won't be able to service the debt.
Right. So it sounds like, if you're one of those people who is in that position, patience really is your greatest asset right now, right? Just keep
Yes.
nurturing that dry powder, keep adding to it if you can, keep doing whatever you can to minimize your vulnerability to losing your income stream. Sort of see how this is going to play out. Now, nobody can pick the exact bottom, but you can kind of get a sense for, like, hey, if the Fed is still hiking rates, and then if we do indeed enter a recession and layoffs start, as long as the layoffs are continuing to happen at volume, you can kind of tell yourself, all right, we're not over yet if those two things are still going on, right? If the cost of debts continue
Right.
to go up and people are losing their jobs, once maybe both of those are over, then you can say to yourself, okay, this might not be the exact bottom, but the worst of the things that are going to influence home prices are now behind us. Maybe I can start actively looking now. And of course, to your point, the house has to be a good value based upon your financials, no matter what's happening in the macro environment. But once that dust has started to settle that we just talked about, then you start looking at the targets that you can afford, and maybe that's when you create your shopping list.
Yeah, that sounds about right. Yeah.
Okay. All right. So I did say I'd ask you about your thoughts on the Airbnb model. And you already sort of partially answered this by saying, hey, you got to become really differentiated. So do you think, again, once the dust settles and let's say the real estate market reprices to something that's more sane and sustainable, will we see the return of the whole short-term rental market back to its old glory? Or do you think it'll be something that'll be a little bit more selective going forward?
I think it will be more selective. I don't know that we're ever going to have, I hope we don't have this mass amount of short-term rentals like we've had this summer. I really think this was like a one-time post-COVID travel boom demand that is going to be pretty hard to replicate in the future. So I I would love it if it was just, some really cool properties. There's always going to be bigger groups that want that vacation house. They don't want to have a little hotel room. I think it'd be great if some regions could put some restrictions on maybe the amount of short-term rentals, or just in some residential neighborhoods, maybe even ban them if local homeowners are having problems. I think that's going to probably be something by each municipality. Like they need to make their own regulations and rules, and some places already are. Um, but no, I don't think the Airbnb model just dies completely. But I do think we're probably going to see a slowdown in this whole frenzy of pitching this get rich quick idea by owning a bunch of short term rental properties.
Okay. Yeah, and I honestly can't see anything to challenge that at this point. So, anyways, presumably, Amy, we'll have you back on, between now and then to give your color commentary if you see trends changing or whatnot. But that logic stands pretty sound to me. All right, real quick, I just want to talk about the general housing market, and then if you've got time, take a few questions from listeners.
Sure.
So I just want to read a couple of recent headlines. These are all headlines from the past couple of days about the general real estate market. This one's from the New York Post. Home asking prices tumble at record pace as mortgage rates surge. Okay. Redfin has US saw record drop in home sales in September. Yahoo Finance, buckle in for a brutal free fall in home prices because the US housing market is in a massive bubble, experts say. And then today on Zero Hedge, a record number of real estate agents will quit due to the economy, Realtor predicts. As I said at the opening, you monitor the real estate market pretty closely. Are headlines like these alarmist, or are they just reflecting reality?
Honestly, I mean, they are reflecting reality, but you have to remember how alarmist things really were on the way up. So it's pretty crazy to imagine that you're going to have this parabolic rise in 2 short years and not have some sort of equally bumpy ride on the way down. Um, yeah, these are rapid declines in some regions, but at the same time, we're not even back to 2021 prices yet.
Right. Sorry to interrupt, but
And
I mean, just in 2021 alone, home prices appreciated by 20% in a
right,
single year.
and that was with a 3% interest rate. So in my opinion, homes were already overpriced by early 2022 with assuming a 3% mortgage rate.
Yeah, and sorry to interrupt too, but
So
I mean, in my opinion, because I've been following the housing market for a while, I think the housing market was grossly overvalued prior to all the stimulus that then created the massive bubble we're just talking about here over the past year. I could be right or wrong, but you could have made a pretty good argument that housing nationwide was still overvalued before the craziness of the past 2 years.
I have challenged a couple people on that topic just in terms of Dallas Fort Worth. I do not think that our housing market was overpriced in, say, 2018. Other people have challenged me on this. I actually think we were pretty much approaching fair value right before the whole COVID stimulus and all of that boom. I think our region was actually underpriced for several years that many other regions in the country were
Right.
not. They were already,
Right.
California, obviously,
And that,
totally
yeah,
overpriced.
and I'm in Northern California, so I've had that in my face for a
Right.
long time. And what you're saying, and I'm not contending it at all, because I think that's why Dallas has seen such an explosion in growth and in building over the past couple of years, because it was an underpriced market beforehand.
Yes, I do think it was. And I do think some of the remote work and some of the, our economy is really growing here. I think there are valid reasons to say that the floor of our pricing has permanently moved up from those 2018 levels, but that does not mean that it's the 2022 values are fair, because we rapidly swung from underpriced to severely overpriced in about a 2.5 year period.
Yeah, yeah, and I'm sure that's true for Dallas Fort Worth. The only point I wanted to make was sort of nationwide. People are like, yeah, well, things got crazy with the stimulus that resulted in the 20% year-over-year increase and stuff like that. Sort of with the assumption that, hey, if we just remove what happened over the past 2 years, like if we just adjust down by what we appreciated over the past 2 years, housing will be fairly valued. And my point is at least for a number of markets in the country, you can make a pretty good argument that they were overvalued still coming into 2020. Maybe not Dallas Fort Worth, but certainly a number of others.
Absolutely. Many others. Yes.
Yeah. Okay. So since you are in Dallas Fort Worth, though, and that's the market you look at most closely, and I guess you could say it's maybe one of the healthier markets. I hate to use that word, but it is because it was coming off of a lower valued, maybe undervalued state in the recent past. What are you seeing now? Again, not just the short-term rentals, but just the overall housing market. Is that cooling pretty quickly there?
It is cooling pretty quickly, starting around late June. Houses are now sitting on the market for 30, 60 days. Builders, the smaller builders are starting to slash prices, especially in the exurbs where you had a lot of remote people kind of buying way out there, and maybe they got called back to work. Maybe they just realized, hey, I don't want to live in the middle of nowhere. The exurbs are struggling. The core areas and the regular suburbs are holding up a little better, but prices are coming down. We're probably about almost 10% down from the May 2022 peak in many regions of Dallas Fort Worth. But prices are still really high for our taxes, and for when you compare it to the owner occupied rents, I mean, it is still significantly cheaper to rent. So I'm just not seeing where we're going to be getting these buyers, especially if a lot of the investors are kind of sidelined now, and a lot of our real people buyers were people coming from New York or Seattle or California. And if their markets are starting to correct now and they're having trouble selling their homes, they're not going to be coming here either.
Right. Yep. Okay. And I'm curious, the softening that you just described, how conceivable was that in May of this year? Like, was that something anybody in the real estate market was even talking about, or has this just like hit them across the side of the head like a 2x4, just something they were not expecting?
Most people that I've spoken to said it. I remember talking to a real estate agent on Mother's Day weekend, and she said it was like the lights just got shut off. Like the open houses went from bidding wars, which was people with expiring 3% rate locks, kind of like that last gasp frenzy. It would be what I call our early spring market. And then as soon as those rates hit over 5, everything just stopped. I mean, showings were way down, offers were way down. And then when we hit that over 6% rate in June, it was dead. I mean, only the best houses were selling. There's no more multiple offers. There's no more, most things. I think the average right now, they said, are selling 96 or 97% below list. So for the most part now, everybody's bidding under list. Probably 20 to 30%, depending on the town, of the homes that are sitting have price cuts now. And it was pretty abrupt because we had a lot of agents here sticking to that narrative of, well, Dallas didn't really correct very much during 2008.
Right.
But Dallas didn't really go up very much during 2005 to 2007 either.
All right. So sort of what you're saying earlier is, hey, it rose very sharply. Not surprising that the decline might be equally as sharp. All right. Well, look, I want to get to Q&A real quick before I do. Just give the 60-second version of your background. So, you live in Texas, you follow the Dallas-Fort Worth market, but you've got a background in economics and in journalism, correct?
Yes. Yes, I am not native to Dallas. I grew up in the Chicago area, but so that's why I don't have an accent. Although I do not live in a suburb where it's very cowboy. The joke is you have to live in Fort Worth to find the real Texan cowboys. Dallas is a little bit more of kind of a blend. It's very most of the people here are transplants.
Been watered down from exiles from my state.
Yeah, a lot of them from California, the California refugees, we call them. Um, but yeah, my background is in journalism. My degree is in economics, and I did some graduate coursework in journalism. Was on the path to attend Medill for a master's, and life got in the way. I got married, had a baby, and started really questioning that $100,000 student loan I would need for that graduate degree. So, yeah, and then I've been a stay-at-home mom for the last 9 years. So I've done some freelance writing, but not a ton. And I did a little bit of work in broadcast journalism back right when I graduated college, but it wasn't a positive experience. So kind of transitioned out of that quickly.
All right. Well, I do want to say, as somebody who sort of discovered you on Twitter, I've really enjoyed and valued the insights that you share on your Twitter feed. And folks watching, if you don't already follow Amy, you should. Her Twitter handle is at Texas Runner DFW. You should go follow her now. All right. So, Amy, if you got some time, I'd love to ask folks to
Hmm.
raise their hands, and we'll take a question or two.
Okay.
All right, folks, if you'd like to ask a question, if you know how to use Twitter Spaces, just request to be a speaker. And if I can figure this out, I will bring you in. All right, I see Austin here. Austin, I'm going to try to bring you in. And Amy, it usually takes him about 5 seconds or so for Twitter to activate him.
Okay.
All right, Austin, we see you.
Hey,
I
so
see him.
one thing I noticed that you said that as like prices decline, you think that people are going to start jumping into the market because they just want a decent deal. As one of those people, one thing I'm just trying to work through for myself is a big factor in that isn't necessarily just the price, but also the financing cost. There's people you talk to. Do you get the sense that people believe mortgage rates are going back down to a more normal level, or do people believe that this is a new normal?
That's a great question. A lot of the people that I talk to just continually refer back to historical interest rate charts, which show that rates historically trend down. Um, Whether or not this is a new normal, that's kind of up for debate. But traditionally, rates trend down. And my opinion would be based on history. What will probably happen is there will be some sort of a recession, whether it's mild or deep, and we'll start reverting back to rate cuts and the whole QE stimulus cycle. Um, from a macroeconomic standpoint, there's discussion of how many more of those cycles we can get away with as a country before hyperinflation or whatever. There's all sorts of possibilities there that I'm not fully able to address, but traditionally, I do think that rates after these hikes will come down. I don't know how soon they'll come down, and I certainly would not buy a house that you're uncomfortable with the mortgage on right now, thinking, "Hey, I'm just going to be able to refinance this later," because you don't know when later will be.
I entirely second her last point there, which is whenever you do buy at whatever interest rate, it should be one that you could sustainably afford, even if rates don't come down. I talk to, so for those of you that don't know me, I run a macro channel on YouTube. I interview people every day. I do 5 to 6 videos a week. So I talk to a lot of experts in the markets, in the economy, and they have different opinions, but if I could sort of blend the consensus together, I think they think that the Fed will largely keep hiking until something breaks that it then has to fix, meaning rate hikes will probably continue up until some point where the Fed changes policy. As Amy said, the likelihood is at that point it will probably go back to rate cuts at some point. And I think you have to keep in mind too that right now the Fed is hiking hard to kill inflation. So, last time we did this, you can use as an analog. Volcker brought rates to crazy levels, but he didn't keep them there forever. Once the back was broken on inflation, they came way back down again. In fact, we had 40 years of interest rates, trending down. I think most of the people I talk to are of the mindset that the zero to near zero interest rate policy of the Fed is probably is a new average floor forward. They expect them to come down this level that it's in right now. Don't expect it to go back as low as it was before. Perhaps that means the days of 3% mortgage rates might be over. But I think they would say in general, once the inflation monster is more or less slain, the Fed will, for a whole bunch of reasons, probably go back to at least bringing rates down to a more manageable level for the overall economy. And if something's really broken in there for a period of time, may have to go back to the type of stimulus that we saw over the past couple of years. But most important message is and look, I think if prices come down to where you can buy them affordably at current interest rates, I think if you do that, odds are pretty good that as the Fed starts taking the actions that I talked about, that you'll be able to refinance at more attractive rates, but you should not make your purchase decision predicated on that.
Yeah, especially because I think it was Lance Lambert who brought this up earlier, is you cannot easily refinance, and you may not even be able to at all, if you have negative equity. So that's another important thing to
That's a
keep in
great point,
mind. So you may find yourself in a situation where rates do start coming down, but you're a little bit underwater on that property. You're not refinancing.
It's a great caution to flag for folks. All right, Austin, thanks so much for the question. Andrew, we're going to bring you in.
Hi. I'm not sure, Adam, if you introduced me or not, but
Yep, no, we can hear you. Keep
okay.
going.
Yeah, we can hear you.
Hi, guys. Adam, thanks for hosting. Amy, thanks for being interviewed by Adam. One thing that's really different this time is the amount of institutional investors involved in real estate nationwide. Are you seeing that from your point of view in Dallas? And how sticky is that? Is that going to help hold the floor up higher than people think? That was my question.
That's a good question. And that is really tough because this whole iBuyer model is relatively newer. This was not around in the last housing crash. We do have a pretty sizable amount of open door owned properties sitting on the market right now that they're selling. I don't know how much they're actively buying right now. Based on people that I've spoken with, the open door offers that are coming in now are so below what they consider market value right now that they're not even entertaining it. But yeah, I mean, I do think there could be a price floor that maybe where cash investors would be more willing to come in because they aren't as concerned about interest rates. And they would say, hey, this property's cheap enough. I'm going to buy it. But I don't know because we've never really been in a situation before where we've had this many big players trying to buy single family homes. From what I've seen so far, I'm not seeing it scale well. I think homes are very personal. Property is personal. Buyers don't like vacant homes. They don't like these generically staged homes. Consistently, what we see in our market is a home that's well staged and lived in by a real family would be getting more competitive offers and be more attractive on the market. And there's really nothing that the iBuyers can do about that. And another point someone brought up to me that I thought was really great is the iBuyer model almost inadvertently selects for the worst homes, because the people that have a home that's kind of a lemon or has mechanical problems or it's going to fail an inspection, those people are going to seek out an iBuyer
That's a great
who's
point.
got cash, who's going to say, okay, hey, we're going to lower our offer by X because we found this foundation problem, but we're still going to buy it. So I think iBuyer properties might have a bad stigma attached to them as being those like unsaleable properties.
Great. I think the only thing I'd add to what you just said there, Amy, is there are some players out there. So Blackstone has already announced that they are building a cash war chest to
Yes,
deploy.
Invitation Homes. Is that their? I think that might be their company. I'm not sure.
Yeah, I think I don't know with certainty either. But so you have some big players who are publicly saying, yeah, we're going to be poised to move, if there are better values ahead. But that being said, and Andrew, I don't know when you logged into this space, but we talked probably about a half hour ago about some of the risks of these institutional buyers as being, if they get in trouble, more likely to be kind of cut and run holders of property, and potentially, flooding markets if they're just dumping a bunch of properties at once. TBD how the script actually plays out. But it'll also vary greatly depending upon, which markets the more solvent guys are focused on. But I think you're going to see a lot of variation, I guess. And I feel personally pretty confident that you're going to see some to a number of markets where the institutional buyers end up being a net depressor of prices as they get in trouble.
Totally makes sense. Thanks, guys.
All right. Thanks for the question. Yemen, I think you have been requested like the whole time, so I'm hoping you have a question. I'm going to let you in first, and we'll see if you still have a question, and if not, we'll move on to Kevin.
Adam, thank you. I heard, I think you, and then the rest was in transition. Did I miss something?
Okay, no worries.
Okay.
Nope, just we're just letting you speak. So
okay, 2 questions.
You got the floor.
Thank you. 2 questions. Thank you for hosting, by the way, and thank you, Amy, for speaking. 2 questions there related.
Sure.
How many units do you see switching from short-term rentals to long-term rentals or coming to the market as sale? This, let's say, in the next 3 to 6 months, so in line with the AirBnBust thing.
Oh, that is a really hard question. So based on the research I've been able to gather, is there are currently around 2 million short-term rental properties in the US. There have been a couple people that have refuted this with lower numbers or different numbers, but pretty sure Ivy Zellman backed that. Hers might have even been a little bit higher, and I generally trust her. So,
All right. And
if you've got
I'm
2
sorry,
million,
you got a little, you glitched.
oh,
Amy,
I
you
glitched.
glitched a little there. So if you could just restate the numbers, I'm not sure everybody heard them.
Oh, I think around 2 million total are what we have on market right now.
Okay, and that's
Now,
short-term
how many of
rentals?
those are? Yes.
Okay, and sorry
That's
to
the
interrupt you,
most accurate.
but just so you know, right before this space, I went to the Airbnb website, and at the
Mhm.
end of 2021, they had over 2.1 million listings, which might not
Oh,
all be
so maybe my
units.
number's low.
Yeah, your number might be a little low as a
Okay.
result. Yeah.
Okay. Ivy Zellman had 2.5 million. So that she might be more accurate then. There's various sources online that have all sort of pitched out different numbers, and I'm not honestly sure which source is more accurate than another. But if you've got that data, then that's great. But what percentage of those are going to come back on market? I mean, put it this way, 50% of those at least were purchased in the last 2 years. So you've got to assume that a significant chunk of those people might start running into either cash flow problems or equity problems if the market continues to correct down. So a good chunk of those people are probably going to be forced to convert those into long-term rentals or sell them. But in terms of a hard number, it's really hard to say.
Thank you. And I trust Ivy's work as well. And Amy, I enjoy your tweets as well. So with 2 million short-term rental units, half of which potentially could come to market, and then a record number of multi and single family units currently under construction and likely coming to market this spring and next, and demand seemingly dead at 7% mortgage rates, how far do mortgage rates have to come down to balance supply and demand nationwide this year, in 2023, let's say, with what we know about supply and demand today? And thank you, that's all.
I don't know that mortgage rates have to come down. It's either got to be rates or prices or some combination of the two to hit affordability. You've just got buyers looking at that monthly payment. Here's my budget. Here's what I can afford. Whatever combo of interest rate and home price can get them to that budget is when they're going to buy. Assuming also, you've got to account for the recession fears and just general psychological fear. If a market looks like it's crashing, people might get cold feet, even if they think the home is a good deal. They still might be scared. Like, what if it falls another 10%? I don't want to lose my down payment money. But yeah, I don't necessarily think it's a matter of rates coming down. I think it's a matter of prices coming down. And I think especially with those units under construction by builders, you're going to see the builders more eager to cut prices swiftly because they've got a business to run and they don't live in the homes and they've got to move
Yeah,
them.
they've got a sunk cost. They've got to sell it for something
Yeah,
because
sunk
otherwise they
cost.
get zero.
Right. They get yeah.
So I totally agree with you, Amy, and I've had some recent discussions on Wealthion, about the high interest rates, the high mortgage rates back in the 80s, and yes, they were high, but they were actually more affordable because the price to income ratio of the housing stock was much more reasonable than it is today. So it's an exact validation of your point there, which is we don't so much have an interest rate problem, although of course nobody likes interest rates to go up if you're a homeowner or a home buyer. But what we really have is a pricing problem, and even at the 3% mortgages that we were at earlier this year, we still had a massive affordability problem. Amy, you read a lot about the plight of the millennial generations and younger generations. I mean, there's just a ton of folks that were getting priced out at those prices, let alone the fact that mortgage rates were the cheapest they'd ever been.
Yep. I completely agree with that.
Okay. All right. Guys, I promised Amy that I wouldn't keep her all night because she has a family that she has to get back to, some young ones that are depending on her. Amy, we'll take just one or two last questions if that's okay with you. Kevin has been patiently waiting, so I'm going to bring him in.
Okay.
All right, Kevin, the floor is yours.
Oh, hey, Adam. Hey, Amy. Just want to say both
Kevin.
you guys do a great job on Twitter and enjoy reading all your stuff.
Thank you.
But I wanted to make a comment more so than a question that a lot of people, listeners that might be on this, everyone's always looking to increase their wealth, but factors that people don't include in their calculations frequently are the transaction cost to acquire the asset of the house, and then also the transaction cost to sell the asset if it doesn't work out. So there's a lot more risk when you buy a house for $500,000 with a $20,000 acquisition cost, and then if you have to turn around and sell it for $500,000 and it costs you $30,000 to get rid of it, it ends up being a really expensive mistake, so to speak.
That's a great point, Kevin.
Yeah.
And on top of that, there's just all the costs of home ownership, that go along with it, the maintenance, insurance, and all that stuff. And Amy was saying earlier that a lot of these short-term rentals, might convert into long-term rentals. And I don't know, Amy, maybe we'll see finally a relief for renters where, for the past 10 years, rents have just been inexorably going higher and higher and higher. For folks, I live in an area where most families that grew up in this area have had to move because they've been priced out. Maybe
Your people have brought that here, Adam.
Yeah, well, because they had to go somewhere, so they went to where you live. So maybe that trend, reverses, or at least gets a breather, where people all of a sudden realize, hey, not only can I get a cheaper house to rent, but maybe I was thinking about buying, but maybe I'm not going to buy right now because I've done the math, and the math of renting at these lower rates is actually maybe favorable. So.
Yeah, I think that's a great point. Yeah, Kevin, thank you for sharing that point. That is valid, and I think that it is worth looking at the opportunity cost of your capital, because the dollar is strong right now, and if you've got cash, do you want to deploy that cash? Spend $50,000 on a transaction or a down payment or whatever, when you could be putting that money somewhere else and earning a certain yield versus an asset that questionably may go down in the next year, and a lot of people say will go down in the next year.
Exactly. And that was more just for people that may be on this audio cast that are interested in possibly getting into the business versus people that already know what they're doing. Just a warning. It costs zero money to trade stocks on Ameritrade, where real estate, again, is expensive to transact when you both buy and sell.
Right. Now, I mean, and there's
much less liquid.
Much less
Yep.
liquid. Now, there are tax benefits and other things like that, but Kevin, your points are great. And you sound like a man talking from experience. Do you work in the industry?
Yeah, I've been in real estate since 1989.
Okay. Well, look, while we have
Wow.
you as a speaker, what do you think about today's environment from a buying standpoint? You agree with our point of just, look, patience is your best friend right now, or do you have a different opinion?
Oh, I agree with that. The other thing that's tough that I'm seeing, I lived in New York State for 57 years and moved down to Florida here a year ago, and it is local in nature. The trend I see, especially living down here, is a massive migration of people from the northern states where they're unhappy with the weather, the taxes, and the politics. And even though the market is slowed dramatically, I think in a lot of other areas of the country here, it's been very minimal as far as the slowing. The number of transactions aren't there, but the pricing hasn't really come down that much.
Mm-hmm. And it's just a great reminder, and we probably should have said this multiple times throughout this space, local mileage always varies in real estate. So a lot of the things that we're talking about are kind of at a general level, but the way they play out in your particular locale are going to be entirely dependent upon the idiosyncratic, unique attributes of where you are.
Right. And I'd seen prior bust, back in 08, 09, where people would literally have to come to the closing table with a check for $200,000 to liquidate their house. And people just don't think that can happen, and it can happen.
All right. Well, folks, that's the voice of experience there. All right. Well, look, we're going to end on that so I can keep my promise to Amy. Amy, thank you so much. Folks, if you've enjoyed this, again, follow Amy on Twitter at TexasRunnerDFW. If you don't follow me, please follow me at Menlo Bear. And if you enjoy sort of long form macro interviews and discussions like this, like I said, I do them 5 to 6 times a week on my YouTube channel at Wealthion. That's Wealth ION. Feel free to go follow that for free as well. Amy, it's been a pleasure. I really hope we get to do this again at some point soon.
Yeah, I'd love to. Thanks for having me. This is my first space, so it was fun to try it out, and you were a great person to do it with. Awesome host, so I appreciate it.
All right. Well, thanks so much. Everybody else, thanks for listening. Give a high five upon leaving, and have yourself a great Sunday night, and we hope to see you on Twitter Spaces again sometime soon.
I hope you enjoyed this Twitter space with Amy and me. I do these Twitter interviews with increasing frequency, so if you'd like to be kept in the loop when my next one is going to happen, follow me on Twitter at Menlo Bear. I also share a steady stream of insights, headlines, and charts that catch my eye throughout the day on that platform. It's a great way to stay connected with me as you wait for the next YouTube video to come out. And as always, if you enjoyed this interview about the AirBnBust and would like to see coverage of similar topics on this channel in the future, please do me a favor and support us by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Thanks so much for doing that, and thanks for watching. you.